This is NVIDIA in 2025, the most watched stock on Earth. Up 32% on the year, but only after a 38% crash, a manic recovery, and a record-setting October. Now, imagine you had one trader's exact playbook to navigate it. 4 chart patterns, 4 rules. A track record so absurd it's IRS verified. Dan Zanger, the man who turned $10,000 into $42 million in 23 months. The world record holder for the largest one-year portfolio gain in stock market history. Today, 5 trades, $100,000 account, Zanger's exact rules, NVIDIA's real 2025 chart. By the end of this video, you'll know exactly what his system would have produced, including the trade that lost money, and why that loss is the most important one. Let's get into it.
But, there's nothing worse than getting chopped up like I did previously. And I have just decided, they will never get me again. The market is a game. The market is here to take your money. It's not here to hand you a check. Once that became very clear to me, I would never let them get me again.
Zanger's story isn't what you think. He spent 20 years building swimming pools in Beverly Hills, trading stocks from his pickup truck with a 3-foot antenna and a brick-sized cell phone. In 1997, he went broke. Margin called when his broker couldn't take his calls. He sold his Porsche for $11,000. After paying off the broker, he had $10,775 left. That's when the story starts.
I actually wound up going broke when they couldn't take my call. I had all these stocks in margin, and it was a vicious break in 97. So I sold my Porsche for $11,000. I owed my broker $225. I quickly went, by this time I would never believe in stocks ever again.
Right.
Only believe in my stops, and I would never take a loss ever on a stock again. That was my new mantra.
February 1998 to March 2025 months, Zanger rode the dot-com explosion. Yahoo, Amazon, Qualcomm, JDS Uniphase, he turned that $10,775 into $42 million at peak. Tax returns audited. Fortune magazine cover. Largest verified one-year portfolio gain in market history. Here's the question that matters. Those moves happened during the dot-com bubble. Stocks doubling in days, gapping $75 on earnings. No algorithms. Can the same 4 patterns work in today's market with AI, algos, microsecond execution, fractional shares, and 0 commissions? That's what we're about to find out.
People called me, "You're the Iceman." I never ever spent a dime. That I bought one Mercedes after I cleared my first million, which was an improvement over the truck. But I never ever did anything else. I was so committed to just watching the market, ups and downs, and never have it. If you made a big day, one day I made $5 million in one day. On a big, stocks were moving, $30, $40, $60 in a day back then.
Sure.
And sometimes they would do, anywhere from $30 to $180 in 5 days. The list is long how many times these stocks would move. Nothing fazed me. I never went out and bought dinner. I didn't buy a good bottle of wine. I was just emotionless about the money and the finances.
And if you're thinking that Zanger just got lucky on .com, recall our last video, the Maggie deep dive video. He tells you what Wall Street doesn't want you to know.
But remember, guys, you only need to get rich once. All you have to remember, you only need like a couple of bull runs in the markets to make a lot of money, to make life-changing money.
That's coming from a guy who made $100 million in 10 years, and a quarter of that came from just 2 trades on GameStop in the span of 1 month. And like Zanger, he'd blown up accounts, but he knew that it's about having your system dialed in regardless. And the market will produce moments where the going is seemingly too good to be true. That's when you attack and be your most aggressive. That's how almost all the top traders made it. And you only need to make it once. What does George Soros say? Meanwhile, in New York on Tuesday, the 15th of September 1992, the day before, Black Wednesday, where afternoon trading was still going on, Stan Druckenmiller, the chief portfolio manager at Mr. Soros's Quantum Fund, read Mr. Schlesinger's remarks and decided that the pound's devaluation was inevitable. That decision, Mr. Malaby wrote, set up this scene. Druckenmiller walked into Soros's office and told him it was time to move. He had held a $1.5 billion bet against the pound since August, but now the endgame was coming and he would build on the position steadily. Soros listened and looked puzzled. That doesn't make sense, he objected. What do you mean? Druckenmiller asked. Well, Soros responded, if the Schlesinger quotes were accurate, why just build steadily? Go for the jugular, Soros advised him. They reportedly made around $1 billion on the trade. Some estimates run higher. And Soros became known as the man who broke the Bank of England. Druckenmiller could see that Soros was right. Indeed, this was the man's genius. Druckenmiller had done the analysis, understood the politics, and seen the trigger for the trade. But Soros was the one who sensed that this was the moment to go nuclear. When you knew you were right, there was no such thing as betting too much. You piled on as hard as possible. For the rest of that Tuesday, Druckenmiller and Soros sold sterling to anyone prepared to buy from them.
It's time to move.
Why just build steadily? Go for the jugular.
Right.
You know, you have to wait for the fat pitch, that one big mover that's going to really move. That'll make you more money than you know what to do with.
Zanger's entire system reduces to one sentence. Price plus volume equals everything. No indicators, no MACD, no money flow. Just patterns refined over 5,000 hours of chart study.
Get rid of all the stupid indicators out there, all this MACD stuff and volume accumulation and money flow. I don't use any of it. It's totally worthless. It's price action, it's volume, it's chart patterns, it's spectacular earnings. And that's all there is.
4 setups. 4 trades on NVIDIA. Double bottom trade 1 April. Cup and handle trade 2 May. Flat base trade 3 June. High tight flag trade 4 October. Everyone represents the same thing: institutional accumulation, supply being absorbed, demand taking over. The shape doesn't matter. The supply-demand mechanic does. 4 rules govern everything. Enter within 5% of the breakout. Take partial profits at 15%. Trail with a rising moving average. Cut immediately if the breakout fails. That's the entire system. Now let's apply it. April 2025. NVIDIA is in chaos. The DeepSeek panic in January crashed the stock 17% in one day. By April 7, it had lost 38% from its peak down to $86 intraday. Here's where Zanger's first pattern emerges. April 7, initial low at $86. NVDA snaps back violently to 114 on 6.5 billion shares of volume by April 9, then drifts lower for 2 weeks. April 21 second test. The low, $96.88, higher than the April 7 low. The second bottom is higher. That's confirmation.
Every stock has its own unique personality, and I always say you have to get to know the behavior of your stock, its personality, and you know, you'll know when your stock is feeling really good and frisky and ready to make a big run. And
April 23 breakout. NVDA clears 102 with 2.33 billion shares of volume. The 10-day moving average crosses above the 20-day the same day. That's our trigger. 250 shares at 103. Stop at 97 below the second low. Account risk, 1.5%. Over the next 3 weeks, NVDA grinds to 115, then to 122. Sell partial at 115. Sell the rest at 122 when our next setup forms. Profit, approximately $3,900. Account, 103,900. And just like that, your first Zanger trade is in the books. No prediction, no hero calls. Just a W shape, a moving average cross, and a stop you never had to hit. That's setup 1 of 4. The next one's already building on the same chart, and it's the most famous pattern in all of technical analysis.
When a stock breaks out and runs, you don't want to pay up by more than 5%. The higher you pay up, the higher your cost is. Stock reverses, then you get underwater pretty quick.
Setup 2, the cup and handle. Zanger's signature pattern, the one he traded most during the bubble. Every major .com winner formed one before its big move. Look at NVDA from early April. The cup forms from the $86 low, rounds out, and approaches the prior pivot near 117 by early May. Then the handle, 5 trading days, May 5 through May 9. NVDA pulls back from 118 to 113. Shallow. Volume dries up. Classic supply absorption.
You know, basically stocks would go back and forth, maybe from $50 to $55 for a month at a time or 2 months. And then as soon as it hit 56, he noticed that the stocks would take off and start to run.
The 12th of May 2025. NVDA opens at 121.94 and closes 122.97. Volume confirms 2.25 billion shares. RSI sits at 56. Plenty of room to run. 280 shares at 122. Stop at 115, below the handle. Risk, 1.9%. NVDA explodes to 135 within 3 days. By May 29, it tags 139. Take partial at 140 of 15%, gain half the position off, $2,500 locked in. Trail the rest with the 2-1 day exponential moving average. Through early June, NVDA grinds sideways between 140 and 145. The 2-1 EMA rises underneath, tightening every day. June 13, NVDA closes back through the 2-1 EMA. Trail stop hit. Exit the remaining shares at 140. Trade profit, $5,040. Account, 108,915.
I use the 21-day probably as my most frequently used moving average line. If it closes below that, I'll reduce maybe 50% of my position or get out altogether.
The 25th of June, 2025. This is the trade that makes the year. The flat base, Zanger's go-to continuation pattern and the one we're sizing up on. After the May breakout, NVDA refuses to give it back. For 5 weeks, it trades in a narrow band 135 to 145, $10 on a 140 stock. A 6.5% range, tight. Volatility contracting. Volume drying up. This is exactly what institutional accumulation looks like.
Well, I'm a momentum trader, basically trading highly volatile NASDAQ stocks as a general rule. Occasionally I dabble in New York Stock Exchange stocks, but mostly relatively new stocks or high flyers, expensive stocks that know how to move fairly fast. Might be a Netflix or a Google, Amazon. Those are some of the leading names, or NVIDIA. These are big names traded here in the States, and they just have a tendency to keep moving all the time. So once they become big players, so to speak, you can just track them almost indefinitely.
Here's where modern data quietly agrees with Zanger. Historical volatility, which he doesn't use, collapses from 45 to 31 during this consolidation. The market is coiling. Zanger sees it in the chart alone. Modern indicators confirm it. June 25. The base breaks. NVDA gaps to 149 and closes at 154. Volume. 4 billion shares, nearly double average. The 10-day crosses above the 20-day with conviction. Every signal aligned. This is high conviction. Zanger's signature move sizing up on the cleanest setups. We add modest margin and take 800 shares at 149. Position value, $119,000. Stop at 144 back inside the base means the thesis is dead. Risk, $4,000 3.7% of the account.
You know, as they break out, I go 2-to-1 margin, and as the stock runs up, I start peeling back my margin and letting them run. So
What happens next is the cleanest trend of the year. NVDA grinds higher every week through July. 165, 170, 175. July 16, partial at 171, 15% gain, 240 shares off, $5,280 locked in. Then we trail. The 2-1, EMA never gets violated through July or August. NVDA reaches 183 by July 31. Hold. 184 mid-August. Hold. Then August 29. NVDA closes at 174. The 2-1 EMA finally cracks. Exit signal. Sell remaining 560 shares at 174. Trade profit. $19,280. Account, $128,195. 3 patterns, 3 winners, plus $28,000 on a $100,000 account in 5 months, and we haven't had a single losing trade. The flat base just did what Zanger said it would do every single time during the bubble. Contain the move, coil the energy, then deliver the cleanest trend of the cycle. Now, imagine that exact setup firing on the most watched stock on Earth. We don't have to imagine. It happened, and we just wrote it. But the year isn't over yet. Setup 4 is coming the rarest pattern in Zanger's playbook, and the one that doubled Qualcomm in 1999. October was about to deliver it on NVIDIA. September was chop. NVDA spent 6 weeks between 170 and 190. 2 failed breakouts. 1 false move. A Zanger trader sits in cash. He doesn't force trades.
own just about 4 stocks that are really powerhouse stocks when the market bottoms out, and then the market will take off and run for maybe 10, 12, 13, 14 weeks, whatever it does, and then just trade out and then go to golf, go to swimming, go to cash, just have fun and enjoy and wait for everything to set up and do it again.
By late October, NVDA has built a tight 10-day base between 179 and 186. Then October 27, breakout, close 191, volume 3 billion. Then October 28, the day everything changes. NVDA gaps up 9%, closes at 201, volume 5.8 billion shares, 3 times average. The textbook high tight flag breakout, 700 shares at 193. Position value, $135,000. Stop at 186 below the consolidation low. Risk, $4,900, our biggest dollar risk yet because this is the biggest position yet. October 29, NVDA hits 212 intraday, closes 207, up 7% in 1 day from our entry. Here's where modern context matters. The bubble era moves Zanger lived through stocks doubling in 2 days. Gapping 75 points on earnings don't happen anymore. So when you get a 5 to 10% gap on a mega cap, you take it. Exit everything. October 29, close. 700 shares at 207. Trade profit, $9,800. Account, $137,995. 4 patterns, 4 winners, 0 losses, plus 38% on the account in 7 months, and the maximum drawdown still sits at 0. Think about what just happened. The same high tight flag pattern that launched Qualcomm from $40 to $200 in 1999 just paid out on NVIDIA 25 years later. The shape compressed. The volatility coiled. Volume exploded on the breakout. And the move resolved in the same direction, up. Different stock, different decade, different trading infrastructure. Same pattern, same outcome. But here's where the story turns. Because the next pattern looks just like this one, and we're about to take it. And it's the trade that teaches the most important lesson in this entire video. Now, the trade nobody wants to talk about. The 3rd of November 2025. After the October explosion, NVDA pulls back slightly to 202 over October 30 and 31. Then on November 3, it bounces to 208. Looks like the next leg. The trend is up. The prior breakout was strong. Looks like a textbook continuation. 250 shares at 208. Stop at 198, below the recent pivot low. Risk, $2,500, 1.8% of the account. November 4. NVDA opens at 202 and grinds lower all day. Close, 198.66. Below our stop, out. $2,500 loss, 1.8% of the account. Loss, $2,500. New balance, 135,495. Here's why that loss is the most important trade of the year. After November 4, NVDA didn't recover. It dropped to 195, then 188, then 176 by November 21. A trader who believed in the stock instead of the stop would have lost $8,000 on that same 250 share position. A 15% drawdown on the trade, 5.8% of their account, over 3 times the damage. We lost $2,500. They lost $8,000. Same entry, same chart, completely different outcome. The $2,500 loss is the cost of capital preservation. The extra $5,500 is the cost of conviction without rules. 5 trades, 4 winners, 1 loss. Net result plus $35,495 on a $100,000 account. A 35.5% return in 8 months. Maximum drawdown, 1.8%. The most important thing about the failed trade isn't that it lost money. It's that it lost a small amount of money. Because the system that took the loss is the same system that took the 4 wins. Discipline doesn't pick and choose. It applies on every trade, the obvious winners, and the ones that look obvious but aren't. Now let's look at the full year. One last thing. Zanger's patterns were perfected in the dot-com era. Why should they still work in 2025? 3 reasons. 1. Markets are still made by humans, even when traded by machines. Algorithms are programmed by people who learn from the same books Zanger read. They place orders at support and resistance. They sweep stops below recent lows. They chase breakouts on volume. The mechanics haven't changed. 2. Liquidity sweeps and stop hunts, the modern manipulation concept, trending on Trading YouTube, are exactly what Zanger called supply, absorption, and shakeouts. Different vocabulary, same phenomenon. 3. The biggest stocks in the world still move on the same 3 things: earnings, accumulation, and momentum. Apple, Microsoft, NVIDIA all trade in patterns indistinguishable from Cisco, Yahoo, and Qualcomm in 1999. The names changed. The supply-demand dynamic did not.
Some of my takeaways from your quote was the same chart patterns that are in the market today were evident 100 years ago, and I suspect they will be here for many years to come.
These patterns just repeat over and over and over again, and they just go back hundreds of years.
5 trades, 4 winners, 1 loss. A 35.5% return in 8 months. A maximum drawdown of 1.8%. That's the entire year. Buy and hold NVDA delivered roughly the same return, but only if you sat through a 38% drawdown to the April lows. The Zanger trader hit the same endpoint with 20 times less drawdown and half the screen time. No prediction. No catalyst speculation. No belief in the stock. Just 4 chart patterns, 1 moving average, and the discipline to cut losses fast and let winners run. Dan Zanger took $10,000 and turned it into $42 million in 23 months. He did it with the same 6 patterns double bottom, cup and handle, flat base, high tight flag that just produced 35.5% on NVIDIA 25 years later. The same cup and handle that doubled Qualcomm in 1999 just paid out on NVIDIA in May. The same flat base that contained JDS Uniphase before its 100% run just contained NVIDIA from May to June. The same high tight flag that launched Broadcom into orbit just fired on NVIDIA in October. The names changed, the decade changed, the infrastructure changed. The patterns didn't. They can't. Because patterns aren't technology, they're psychology. And human psychology in front of a chart hasn't evolved a single basis point in 100 years. The strategy didn't expire. The discipline did for most traders. If you want to be in the minority that doesn't, subscribe. The Kalamagi breakdown, the modern Zanger who turned $5,000 into $100 million using the same patterns, is linked below. The Martin Luke video, the 23-year-old, who turned $1,300 into a world record using a tighter version of these same rules, is linked below. Same patterns. 3 traders, 25 years apart. One conclusion. The chart hasn't changed. Only the people reading it.